Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Economy Show, we don't want to try to rehash a lot of the old slides that we've done, and it's been a relatively slow week. So we're just going to look at where's the general overall economic backdrop, what's happening in small businesses, what's happening with mobility in emerging markets, and then wrapping up with China, India, oil demand, and where does that sit as we go into a geopolitically uncertain area in the Mediterranean. So just kind of kicking off as we go into the economic activity, I think this is a good chart that really dictates kind of where things are sitting. And as we see some of this leveling off, we've seen an industrial production increase as we went through June. July should see another increase, which will be positive, but you're starting to see some of this weekly economic indicators from the New York Fed start to level off as some of the data starts to come in a little bit softer as we look at CapEx spending, as we're looking at earnings, and as we look at employment, which is something that we're going to talk about more aggressively as we look at small businesses. But again, these are things that have obviously come off their lows. We're starting to see things come back. The question is, can we see some of this increasing as we go through the remainder of the year? And again, this is something where we've talked about coming very hard off the bottom, but now we're starting to hit that plateau as we continue to look at the mobility data and that those daily indicators. Now, the one thing that we have to talk about, just because the moves have been just insane, is obviously lumber. Lumber has gone limit up on multiple occasions over the last, let's call it the last 3 months. And now limit up, for those that don't understand, limit up, so the exchange sets the percent move that's allowed before the future stop trading for that day. And it varies based on the actual product, and lumber has hit that mark again today, which is August 12th, because you'll see the show tomorrow. So you're seeing this increase in demand, and the anecdotal component is we are short supply when we look at people moving from the urban into the suburban and even the rural part of the country. And just anecdotally, so my father-in-law owns a golf course out in Massachusetts, and they're building homes along this golf course. And phase one was about 27 homes. 20 sold quickly ahead of COVID, and then obviously things slowed down, selling about 4. And now with the people starting to come out, they have now closed phase 1 and are already taking 4 reservations on phase 2 as you're starting to see some of this demand rally. So it's interesting because typically when you look at housing, you could say, well, how can the economy be weak with housing being so strong, lumber being so strong? And it's a shift because there is a huge pent up demand in this move, in this work from home mentality, now that we're seeing this shift. And then the question is, as these people move out, are they going to require a car? What will driving look like, especially if you're working from home? Do you still see the same increase in miles driven? And these are questions that we're constantly going through. But the short answer of lumber is going to remain strong. You're going to continue to see some construction spend as you get some of these homes being built to kind of close some of this gap. Now, that is the relative bright spot, but now the question is going to turn to what's happening on the job front and how is this really impacting? Because when you start to see, okay, well, people want to buy homes, people want to move out, but do they have the capital? Can they get the loan? Can they actually capture that mortgage rate, which continues to fall and remain, let's just say close to 3.25%? And here's some of the kind of breakdowns in terms of where have we seen some of these employment increases and decreases. And the public sector and public admin has seen an increase, which has helped to kind of offset some of these declines in the private sector and other. But again, accommodations and food remains the bigger problem. And it's also important to appreciate the self-employed individuals continue to dwindle as they either look to get a regular job because they no longer have the balance sheet to try to get it going, build a business. So these are things that, again, take time to work through the system, and we think is going to continue to weigh on overall spending. as we start to look in the next few slides. And this is where we start to look at that small business revenue. So you're seeing that even though states have reopened, you're not seeing that revenue transition. And this is where we continue to remain concerned, because even though we're getting that reopening, people just aren't getting back out there. And again, it comes back down to, am I going to have a job? We saw Ford is looking to lay off about 10,000 people across Europe. You're starting to see these large companies make additional cuts, which is making people uneasy. We have anecdotal evidence of people with high-paying jobs that have been at some companies for 20 plus years starting to get offered a buyout. And the question is, if you don't take the buyout, what does it look like if they do come and lay you off? And these are those issues in terms of revenue. And the problem is the furloughs are going to turn into full unemployment, and that unemployment is going to remain sticky as companies just don't have the revenue to support people coming back. And that's where we start to look into the small business. And so small business optimism index. Now that this is more of like a leading indicator of, because as you start to feel better about the economy, you're going to make investments, you're going to start hiring people in preparation for those investments as you start to see some expansion. And that's starting to slow down, which if you consider, if you go back to 2016, like that was the election. So you always get a little bit of an uncertainty as to, okay, well, if Biden's leading, is he good for the economy and small businesses? Is Trump better? And how is this going to play out? So some of the uncertainty will keep people on the sidelines. And then obviously you have COVID and you have the other issues in terms of just general activity, which is going to continue to weigh on that optimism level. And when we consider the optimism, you can use on a small business side, actual earnings continue to remain under significant headwinds. And these headwinds are going to continue. And if you're not earning, that means you're not going to spend. And this is where we come full circle back to that employment question, which is going to be problematic. Now, we talk about consumers getting credit, but what about the companies getting credit? And those credit standards are starting to ratchet up as well, especially as earnings continue to fall, revenue continues to be anemic. You're starting to see some of this pressure, which this is where we look into the tightening standards in terms of the loan market for large, medium firms. And that's where we're seeing that tightness, because if you think about where this is on an inverse level, that dark blue line is showing how you're getting loan officers essentially saying, look, we're going to be requiring stricter terms in terms of what loan we're going to give, what kind of proof you have to show, the income levels. And this is going to lead to additional slowdowns in terms of CapEx and that local spending, which again goes back down to how are we going to re-employ these people that remain on the sidelines. And that's where we look to the consumer delinquency rate, because if you don't have a job, if you're concerned about your job, well, what can you wait to pay? And here you continue to see those delinquency rates. And again, as delinquencies start to increase, so does the bank's willingness to make new consumer loans, because if you're considering how banks operate, they have to preserve more capital in bad debt expense. And now that capital is spoken for, they can't turn around and make a new loan, because they have to essentially backstop their balance sheet to make sure that their leverage ratios remain within a comfortable area that not only regulators, but also the bank themselves can feel comfortable with their position as we continue to remain in a very uncertain period. And that's where we consider loan performance over the longer term. And the question has always been, well, where is it versus 2019? And here's kind of that snapshot of where things sit versus 2019. Now, this is as of May, so the numbers did get better in June, and then they remain relatively stagnant with a slight decline in July. But you can now get a real sense of where the pain is and where the struggle is going to be. Now, as we start to look towards loan performance and we look at the delinquencies, the bankruptcies, all of these different pieces, what is going to happen to commercial real estate, the urban areas? We've seen Simon talk about turning some of these storefronts into Amazon fulfillment centers. How are you going to see some of this massive amount of commercial real estate essentially get filled? And these are where we're starting to see some of these loan performances start to weigh not only on mortgages, but also across other loan loan areas. And again, this is coming back down to rent collection. So you can see, again, things got better in July, into June, and now we're starting to see things start to level off. And then as we lose some of the unemployment benefits in terms of the $600, which expired in July, we don't have that $1,200 paycheck coming from the not paycheck. I'm sorry, the stimulus coming from the government. The view is that this is going to start to creep higher as people are losing that additional income that was helping to bridge some of that gap. And this is why we continue to look at, well, what's happening with rent, and the rent collection's going to get worse as we go through August into September, unless we get some new form of stimulus, which is likely. The question is going to be how much. But then when you consider where all of this sits, now you also have inflation. So inflation is starting to creep higher. You're starting to see those inflation numbers come out. In a minute, we'll talk about China and how they're concerned about their own inflation, specifically on food. And this is going to continue to weigh as people have to spend more money on other things while not getting their normal income. Wages are getting slashed as people who are furloughed. You may get $0 based on your furloughed extension, or you might be getting 30% or 50% of your previous salary. So you're seeing costs increase at the same time as your income has been cut in half, which is, again, the problem as we consider how is this going to look as we go through the remainder of the year. Very unlikely that we're going to see any kind of real turnaround. And again, when we come into businesses, like what is happening on business closures? And so this is Yelp looking through the end of July, and you're seeing an additional increase and this expansion of closures across the board. Yeah, restaurants is a bit more obvious in terms of the pressure on getting people, the utilization rates within the restaurants, but also retail shopping and that miscellaneous. The small businesses are really the lifeblood of the U.S. economy, and we continue to see closures, which is just taking more and more jobs out of the market. And the question is going to be, how do we close that gap as we start to see, the mobility and the movements and spending really plateau and nothing really to pick us up because the consumer's not spending, companies aren't investing. Can the government really backstop us? And the short answer is it could be a shot in the arm, but it's not going to be a sustainable move that we really need to see. Now that we can kind of dig in a little bit more on mobility data, what's happening within specific states, and here you can see, just looking at OPENTABLE, these are some of the states that saw some of those increases in COVID cases. And as you can see, as we went from May into June, we had a big increase in terms of reopenings, restaurants were back, bars were back. And then as we had some increases in spikes in cases, you saw that pressure come down through July, and we're starting to see some of this creep back up. Again, this remains a relative problem as we start to go through the remainder of the year, because we're starting to get back to those June highs. And we think that, even if we get back there, restaurants are a bit more cautious. They're trying to take things a little bit slower, making sure that we don't see the same spike and they can maintain their businesses. But at the same time, they're going to have to maintain their business at a reduced utilization rate, using whether reduced patrons within the restaurant itself or outdoor dining. So they inherently just have less seats. So as you start to get towards that down 40%, you're actually starting to reach peak available capacity. So you're not going to see that real shift above. And then as we keep talking about unemployment, about wages. So that's also going to weigh on how much are people really going to be able to eat out. But at the same time, we're seeing this kind of level off, which gives us some confidence that you're starting to see some movement, which should help support some of the restaurants that are currently open. But again, the problem is going to be perception, because how are people going to spend? If they have confidence, fear, how are you adjusting? Because when you consider making a hard decision or weighing your options, it's always easier to say no, or I'm just not going to do that. And there's been studies done, when I won't bore you with some of them, but Israel and America have done some interesting psychological studies in terms of decision making and when is decision making at its peak and at its finest, and what is the easiest answer. And the easy answer is always going to be no. So when you look at how people are weighing their what are they going to do, where are they going to go, are they going to go to that restaurant, are they going to go to that Target an extra time and risk, and you're starting to see some of these issues in terms of what the uncertainty and what that fear looks like. And we're starting to see that really kind of resonate, not only in terms of the working side, but on the stopped working side. And that's the key component in terms of stopped working, and then what happens in terms of education. And you're starting to see some of those things slow down. So again, young people and millennials were those big consumers, and they not only are they starting to be concerned about what should they do and spend on, but they're also going to save for a house. So you're going to make a big purchase on a house. You're not going out to dinner the same way. So these are those little components that we're seeing that pressure within the US. Now, when we go abroad and we look at the manufacturing side, these are some key areas that we're supposed to see some healthy growth, which India continues to kind of be that focal point, and India continues to slow down, which is going to be problematic as we start to see India, not be able to regain some of that growth that they achieved through the, let's call it 2010, as things have adjusted. Now, there's always a shift. So that you also have the growth of services. You also have the growth of some of these other sides of the industry, not just manufacturing, because when you think of it as a share of GDP, it continues to fall. But as manufacturing remains a key component of GDP across Indonesia, India, as global trade remains weak, as we continue to see those PMIs and that pressure, this is where the GDP overall is going to remain under significant pressure, especially when we look at diesel demand, which is why diesel demand remains low, and that shipping demand remains low, because we're just not seeing these movements. And when, again, coming back to those movements, the things that we always look at is the recovering, those high speed or daily indicators that we like to talk about on advanced economies. So here you can see, again, that everything kind of averages into about that 75% of normal, which is something that we remain pretty confident is going to stay that way and actually start to get worse as we go through as we go into the fall and winter months, because the rules, like, I mean, I don't know about you guys at home, but we just got the 22 pages of what it looks like for my kids to go back to school. And essentially, if you have a fever, if you have a cold, you can't go back to school until you get a COVID test. So how are you going to adjust what you do? How are you going to adjust minimizing cold exposure? Before you see family for the holidays, does everybody have to get a COVID test? These are concerns that are going to just hinder the way people go about their daily lives until we have some stability in the market. And then as we go through, again, looking at Europe a little bit more, because the UK put in that pretty ugly GDP number, unemployment remains problematic. Well, let's look at the Eurozone, and here you can see those household spending. Because we talk so much about the US and Asia, well, what's happening in Europe, and you continue to see those households cutting back. Tourism is down, and then just general spending, and especially in Italy, as we continue to see those overhangs. Now, the government is trying to stimulate, they're trying to do different things. They put together the funds to give not only loans, but also grants to try to get some of this normalization. And you continue to see this weight, even though things have gotten better. You've seen Italy, France, Spain see a total reduction in COVID cases. Spain has started to see a little bit of an increase, Germany a little bit of an increase, but again, on the average, it has come down, and you're still not seeing households get back active again. And that's when we get to that, kind of rounding out this specific section, just because we keep talking about credit and the ability to get credit. India is seeing their standards in terms of getting credit for businesses coming down year over year. Now, the government has been able to borrow Some of them has been gold back. Some of that growth has been on the government level, but companies also need lending capacity, borrowing capacity, and lenders continue to shy away from some of these emerging markets as we continue to get some of these uncertainties. Now, India is not alone. We've seen that across the board on the emerging market level, but India is kind of a good bellwether because they were a bright spot, as you can see, from 2017 through essentially the middle and into the end of 2018. India was the investment point. What we always talk about is how 2019 was the start of weakness. We saw it in distillate. We saw it in total shipping demand. We saw it in carload movements, which really started to crack in 2019, which is why we were bearish as we went from 2019 into 2020. And this has just continued and just put another overhang in areas like India, which was really kind of driving some of this global growth, which is going to reverberate through chemicals, refining, oil demand, which we'll go through in a minute in a bit more depth on that oil demand that's going to be lost not only in India, but also in China. Now we can start to kind of show what is this economic impact and how does that really kind of translate into a fall in oil demand, a fall in refinery demand, and then putting additional exports in the market, specifically in Asia. Now, just to kind of look at this from a tanker glut level, when we consider what is the Middle East going to do, do they have the capacity? So we've gotten the official selling price. So the official selling price is kind of that starting point, and then you can make deals off of that. And those deals can be discounts on shipping, a certain free storage for a set amount of time in terms of that timing delay to kind of help some of those netbacks. And here you can see that there's obviously going to be a lot of super tankers that are available for the Middle East to kind of use to help incentivize some of the purchases that we've seen. We've seen floating storage remain sticky and elevated throughout within the Middle East. The West Africa is pared back a little bit, but the Middle East overall, you're starting to see some of those availability. So this allows them some flexibility to be a bit more competitive, and that's something to watch as Asia continues to be flooded with floating storage. So this is something that we are going to keep saying, okay, well, what is happening? Because if you remember last week, we showed that the amount of super tankers heading to China had dropped off precipitously, and this is something where all of those ships are now coming back and they're just sitting there waiting to get filled up with some sort of product. So this is something that would provide some of that opportunity. And when we consider that opportunity, this is just another way to look at that OPEC plus compliance as we saw it drift lower in July, which we talked about last week with our OPEC update, looking specifically at Iraq and some of the other GCC nations. So you're starting to see that compliance, whittle down a little bit as the GCC, which is Saudi Arabia, Kuwait, and UAE, just based on this chart. Qatar is its own entity in terms of how that relationship works, but that's a story for a different day. So here you can see Saudi, Kuwait, and UAE, they had some of that increase in production. But again, you saw Angola miss, you saw Iraq miss, you saw Nigeria miss, on a bigger level. And it's starting to come down to, well, how do we define condensate? Because Nigeria continues to claim that several of their blends are condensate and should not be considered in the quotas because condensate is excluded from these components. Now, there's always an argument as to how does Chevron, Total, Shell classify it? How does OPEC classify it? How does Nigeria want it classified? So these are those friction points as we continue to see some of this cheating remain robust within the OPEC agreement, which is going to be problematic, specifically as we continue to see some of this pain. Like if you remember back to the EIA show, we talked about how the EIA walked back U.S. production. So we saw these huge builds, even though production was lower than they estimated, but was kind of in line with where we estimated, and which means demand did fall as far as we were considering, and demand continues to be a problem. Now, as we go to India oil demand year over year, you continue to see this this weakness with oil demand down year over year about 12 to 13% going into India. Now the problem is LPG did provide some uplift because LPG demand was up and we saw some increases, which helps to soften the blow. So they actually beat estimates. But again, as when we look at what does oil demand look like, what does condensate demand look like, and what does LPG demand look like, oil remains a bleaker outlook in comparison to specifically LPG, and then on a smaller component, condensate. And this is why we think there's going to continue to be a slowdown in terms of just that oil, especially as we have the OPEC cuts getting reversed. We see some increases. We see cheating continue. We're going to see just more and more oil sitting on the coast and sitting in storage as we go into that shoulder season. And that's where we turn to, okay, well, we talked about India. What about China? Well, here you can see China imports also fell in July and are going to continue to fall into August. And so even though we saw a decline in oil imports in both India and China, we still saw an increase month over month in terms of exports of refined products, pointing back to weakness in terms of local demand and just an oversaturation in local storage, which is putting it into the open market, as we talked about yesterday in our EIA show, when we talk about movements from Singapore, from Asia, into the European market, which again is creating some of this friction as we start to see how is it going to impact U.S. exports. And when we look at that floating storage, we actually saw an increase in Asian floating storage. Now, Asian floating storage is obviously all of Asia, so you have to consider, look, China is still flooded. We know that. But this is also picking up that slowdown in India that we've talked about, as well as additional slowdowns within South Korea. So these are those components. Like Japan had another big increase. They're off, so we don't know what this week or what last week was. But again, the indications on satellite, on ship counting is that it's going up, not down, which is going to weigh on overall pricing in the physical market, which will at some point, I don't know when. I'd like to say it would already happen in the futures market, but here we are. So, but these are the underlying impacts to that physical world. And as we start to look towards China and we consider, okay, well, what's happening with China? We've talked about the trade war. We've said it since January 15th when it was signed that the trade deal was nothing. It'll never be met. And obviously COVID it hurt that the ability to hit that level, but we continue to see it ratchet up. Now, this is something that Bloomberg Economics put together versus the U.S. Census Bureau, and you can see the shortfall that we have on total goods from the U.S. into China, which again goes both ways, and there's just no way to really close this gap. And the reason why we bring it up again is because we're starting to see talk about meeting of the minds, see if there's a new negotiation, if they can come to some semblance of an agreement. We're going to say no, because in the election year, you have to be tough on China. You have to show force. And this is something where I think President Trump is going to have to show, look, Biden is the soft one on China. I'm going to be tough on China and hold them to their word, which is, we all know how good the CCP's words are. And when we start to break this out in terms of the different components, you can see manufactured goods missed by a large margin, energy missed by a large margin. Those are things that are not going to close a gap on. The interesting component is going to be agriculture, just because there is a huge problem with food inflation and food security that is only getting worse in China itself. We've talked about it extensively in terms of food security, inflation. And just to give you an idea of where things are now, so President Xi has come out with the member of the Clean Plate Club. And the idea is to clean your plate, reduce food waste. And this is because there are massive increases in inflation. Pork prices are up 86% month over month, which were already up over 100% month over month. So you're seeing a compounding problem we've talked about in our Three Gorges Dam episode, which we'll provide an update with soon, where you're seeing rice paddies get destroyed. You're seeing inherent livestock get killed, crops getting destroyed. So they're going to have to go to the open market to close this gap. And the problem is it's going to have to be subsidized by the CCP as inflation, wages, unemployment remains problematic within China itself, which is, again, the agriculture could be a bright spot as we go forward. And it's important to appreciate, just thinking about where this was. And again, we only have data from a little while ago, but China wasted an estimated of 17 to 18 million tons of food annually from 2013 to 2015, and an amount that could feed 30 to 50 million people per year. So they're trying to use that as a means of clean your plate, like don't waste your food, because they are facing a huge shortfall. And this comes full circle back to COVID will kill hundreds of thousands of people. Starvation and food insecurity will kill millions. And this is the unfortunate nature of kind of where we sit in the world. And that leads us and wraps us up with what's happening in the Mediterranean. Just as it was a great chart that I wanted to highlight again, because we talked about this in our Libya update when we were talking about the exclusive economic zones and the agreements between Turkey and Libya. We continue to see commentary, and the pricing remains relatively stable coming out of Libya. And Russia at this point wants to keep this crude flowing. So just to give you some data points in terms of what's happening on the Urals front. So Urals into Northwest Europe, into Europe in general, continue to trade at a steeper discount. The discount actually increased about 10 cents within the last 2 days. So you're starting to see some of those pressures increase, which is why having the, let's just say, Libyan flow not getting to market is helpful for some of their European prices as it keeps the market relatively insufficient. But again, this is something that's going to have to be resolved, as it remains a friction point with not only Turkey, which remains in its own spiral downfall with the lira and the global and their local economy, which is going to be a problem because Turkey normally sells vegetables to Russia. How does that actually work out on a food level? And then just looking back at Lebanon, because I think it's important to appreciate where Lebanon sits. So the government has now officially resigned. What does that mean going forward will be uncertain. Hezbollah, there continues to be protests against the Hezbollah government. And the question is, you're starting to see Russia and other countries come to the aid of Lebanon and trying to give aid to Beirut in its own right to help it get back on its feet. So these are those intricacies that we're going to continue to see within the Mediterranean and these key economic zones as we go into the end of the year. And we'll provide another update as it becomes available, as new data comes to light. But expect an update on the Three Gorges Dam and just the flooding in the total region. And then we'll provide a geopolitical backdrop as we look at and really go deeper into the China-India friction as we head into the winter months, where we typically should see a reduction in overall fighting. But one of those key roads that India controls is actually an all-weather road with all-weather bridges, which could be vital to China in the winter months, so that we could see some movement prior to getting to that winter freeze-off. So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Stay tuned on for Friday with our Primary Vision Frac Spread Count. Talk to you soon.